All right, we are back. Let's talk futures. Joining us live, Sterling Smith, commodity analyst extraordinaire. Sterling, how are you?
I am doing well. How are things in your neighborhood?
My neighborhood, so down here in Charleston, weather's perfect. Knock on wood, don't see any storms that are about to mess up my life. Everything is good. How about you in the heartland?
Well, here in the blue dot, we're being barraged with political ads. We had an outbreak of
Huh.
E. coli, and McDonald's, if you've been following this in the national news, actually happened here in Douglas County, right here in Omaha. And that's kind of created a little bit of nervousness. But we are all about the election year because remember, Nebraska distributes its electoral votes differently. And whoever wins District 2, which could be Trump or Harris, will get an electoral vote out of this district. There
Oh,
are some scenarios where the next president, everyone's talking about, the president of Pennsylvania and these swing states. There's a couple of scenarios that works out where this district could determine the outcome of the election.
wow. Okay, yeah,
So
so it's not a winner take all state.
it is not a winner take all state. Now, along with this, here's something we want to look at the second derivative with this election. There's something else brewing under the surface that could prove to be a bit of an issue for whoever wins. There's a Senate seat up here. It's Deb Fisher's seat. And there's an independent candidate named Dan Osborne running. And right now they're running neck and neck, maybe even Osborne winning. That would be a loss of one Republican seat. There's a second Republican seat that may fall. That guy's name is Ted Cruz. His race in Texas is also running even. So we could see a situation where Trump could potentially take the White House and lose two Senate seats.
Yeah.
Also, the House race for our district here is also extremely tight, where Representative Bacon does run some risk as well. So that is going to have some effects on the market here. And I think that's part of the reason we're seeing what we were just talking about.
Well, I mean, I'm surprised that the word, that Nebraska is coming up in this conversation. But, I'll be honest with you, we're getting hit by ads and direct mail pieces. And
Yeah, we are. It is a constant barrage that just simply does not
yeah,
stop.
I know. I can't take
And
it anymore. I'm trying to zoom. I'm trying to tune it out. I'm trying to tune it out down here. But in any event, we'll see what happens. What happens, happens. And we do the best we can. But I wanted to, so we had a nat gas report that came out today, which I don't know if you saw it or not. It was a storage report that it was a beat, right? It beat consensus, right? And I'm looking at the chart. Let me pull this up real quick. This is just I have the November contract still up. I know I should probably roll to December, but we caught an awful big bid on an increase in storage in nat gas, and I'm kind of scratching my head on that.
I think what you're probably seeing is the markets are slipping into a de-risking mode from natural gas to the stock market. Any market that is overextended one way or the other is, at risk to changing simply because with the election and not really having a clear outcome or a clear picture who's going to win, people are very interested in getting smaller. They're going to be taking off risk. And I think sometimes you get a situation here at the Natty, we have plenty of gas. I'm short, but I'm not getting the result, so I cover and prices get a little bit of a pop. I think that's what's going on right at the very moment with the natural gas. And also, it's October, prices are depressed. Temperatures here are warm. It was 85 here yesterday, which is not normal.
No.
And we are not yet looking at a hard freeze all the way, into November. So that has depressed natural gas prices. I can guarantee you eventually it will freeze out here and in Minneapolis and Chicago. And I think you see the market now, maybe we have gotten a little bit too cheap. We've come down a lot, and you're seeing some short covering in here, kind of working to elevate prices, which could prove to be transitory until we start to get a really meaningfully cold forecast.
Okay, so that's the seasonal part of it, right? The seasonal part of it is winter's coming. We're going to need more gas to keep everybody warm.
Right. And the market will price into whatever the forecast is indicating towards, temperature drops if we get a deviation. That's what will propel a move. We get the polar pig, all of a sudden, natural gas will catch a hard bid with that. If we
Yeah.
continue with this drift where, we're seeing daily highs in the 60s and 70s, or we should be seeing them in the 40s and 50s, that will constrain the bullish activity.
Got it. Okay, that makes way more sense to me. I was just looking at it, scratching my head, going, "Why isn't this market going down right now?" So,
Well, for the same reason the stock market is going sideways. People, I think, are ducking out of risk. But in the stock market, you have, the risk, oh my God, we're going to fall apart. That's offset by the FOMO. Maybe we will get election results that are very good for some, and that will propel the market. So that's something that can kind of go either way. We've got the NASDAQ leading. A lot of this is Tesla. Okay. Tesla is the big thing that's driving that. And that's why we're seeing this deviation with the S&Ps, basically for all practical purposes, unchanged to just a little bit higher. And the Dow is just a little bit heavier because it's been a bit of a relative outperformer. So you're starting to see some of those Dow positions getting slowly taken back off.
yeah, so Nestle put a charge into the market last night.
It did give the market a little bit of a charge. I don't know if we're exactly at liftoff, but we want to avoid as traders are an unplanned disassembly of the rocket.
I got you. So right now, I just pulled up a daily chart here. I got a couple of support and resistance levels up there. It might be hard for you to see, but right now it's kind of like in my mind we're consolidating, right? We're consolidating above that 2200 level, but below that 2600 level. I'm rounding my numbers off a little bit on the Nasdaq, and I'm always thinking in terms of all right, it's an election year. Is there some kind of seasonal expectation here or not?
Well, actually, usually after elections, and I'm going to put together some research on this, typically after the election, the market tends to do a little bit better. This one may be different. This everything around this election is so different. This is not Mitt Romney running against Barack Obama. Okay. This is different. And the deviations we're seeing looking, at Senate seats that you would expect to be red, Nebraska and Texas, and you've got two of them, not just at risk, a little bit of risk, at very high risk. So there's going to be, voter turnout issues and things because this race for the Fisher seat is tight as a tick here. And I guarantee you the most populated counties in Nebraska are Douglas, Lancaster, and Sarpy. And those are the purple to bluish counties, and there is going to be a full turnout. You can't drive around Omaha without seeing these signs with just a blue dot on them. They're everywhere.
Yeah. Well, and Blue Putnam, who was the chief economist of the CME Group, I had him on the other day. He kind of scared me a little bit. And he goes, Jim, you realize in December, there's a couple of things that we're up against. One, we're going to need another continuing resolution to fund the government. And then two, we have the debt ceiling that we probably need to kick the can again or deal with. And that's kind of an odd time of year, the December, where you have, the administration's not going to change for another month.
Right. And neither will the House or Senate. My hope would be that they would have the foresight, obviously, to pass another continuing resolution and fund the government. And along with that, obviously raise the debt ceiling once again, which at some point we're going to have to, as a country, come to grips with the debt situation and the debt to GDP ratio. And right now we're looking at the two candidates that got us here. If you have the same pilot who knows the same route, the airplane's only going to go to one place. So I don't think we're going to see the big changes and the things that we need to begin to address. I don't see that happening. I see more can kicking, and that can gets bigger and bigger, obviously, as we go along.
Yeah. Well, even Janet Yellen said yesterday, the day before, I can't remember which day. It's like, hey, this GDP to real interest ratio has got to be below 2.0. I think it's about 2.3 now. Even so, now even she's kind of banging on the drum a little bit.
Right. And that's something where, the Federal Reserve does have control of this to a certain degree, and they can work to push interest rates lower. Now, last time I was on, I talked about interest rates and how I thought that there would not be another interest rate cut. You heard it here on NinjaTrader first. Because now, what is the street saying? What are they saying, Jim? What are they talking about?
You know what? I'm going to look it up. I'm going to look up the CME Group Fed Funds tool just in case I'm missing something here. Hang on, I'll get it up here in a second. This is what I go by. I like this tool because it's based on the Fed Funds futures. I think that's a little bit of science to it. Right now, it's still tracking 95% chance for a 25 basis point cut.
Yeah. But that was, we were seeing talk of 50 basis points.
Yeah.
We were seeing a lot higher degree of certainty. That tide has changed ever so slightly.
Yeah.
And the tone that I'm getting from the Fed governors, the tone that I'm picking up off the street is just don't quite count on this. And then if you look at the way the 10 years moved, if you put up a chart of the 10-year futures here, let's take a look at that.
I got it. Yeah, this is startling to me, by the way. Let me get this should be a daily chart right here. I don't have the yield. I have the price of the actual instrument on the screen right now.
Which, if you think about yield, these are just inverted. So it's if you look at where the yields are, it's just the opposite picture of this. When I was talking about markets getting overextended, this was one of the first ones that came to mind, along with the U.S. dollar. We have overextended. Rates have gone up, in my opinion, too much. If you are a hedge fund and you are short these futures and you're coming into an election, you have put nice money in your pocket. You are going to be willing to put that money in the jar. You are going to want to reduce that risk. And how you do that is you start buying up these futures. And that is something where if we begin to get some momentum going the other way, we could see rates come in. And right now, the 10-year is clicking along. We're at 419. The high of the day was 424. So we're 5 basis points off. And we may be getting a sign that maybe we have pushed this market too far. And I always kind of like to look at correlation and things that trade as a team. If we take a look at the dollar index here, the dollar index.
Go ahead.
The dollar index has become extremely overbought. We have, we're pushing, you look at the RSIs, you look at the STOs, you look at where we are. The dollar index is also in a position where we could see the dollar come back in. What brings the dollar down quicker than anything else? Interest rates going lower. So now we have two things with a correlation that are beginning to work together. What are other things that can send interest rates lower? Unnecessary jitteriness in the stock market is something else that could produce this. We're kind of caught in a trap with that a little bit, though, unless we have a big problem, a black swan or, I saw a black squirrel in my lawn here last week, and kind of had we kind of had a black squirrel event. So if we see that.
How does the whole dual mandate come in right now? Now the focus seems to be totally on employment. Everyone's kind of, forgetting the idea that CPI is not a problem anymore, and we'll set aside the idea that Stephen Jonathan told us the other day was like, hey, there's a lot of stuff not in CPI, like some insurance stuff that are problematic, but now it seems to be that the focus is on employment.
Right. And we did see it pop up in weekly jobless claims the last couple of weeks. Those have come back in. We are in a structurally tight labor market. We can see as long as we don't have a recession, it's my opinion that we could keep the labor market at least reasonably tight here. I think that is something at least over, let's say, the next 12 months, unemployment probably is not going to be an issue. And that structural tightness is coming from, hey, boomer, we've got more boomers leaving the workforce than we have Zoomers coming into the workforce. So when you have that natural structural thing, politicians hate to talk about this because politicians want to talk about what they can do. You can't do anything about demographics. You have to learn to work with demographics. And with that being the case, that may be enough to keep the labor market reasonably under control. And we may not be looking at, a big move up in unemployment, which may keep the Fed a little bit calm about cutting
Yeah.
rates.
Yeah. By the way, I think I'm a boomer. My wife calls me a boomer all the time. So I guess I am. And I'm gonna take that as a badge of courage, but I'm not retiring anytime soon.
Well, here's the deal. I was born in February of 1965. The
Okay.
cutoff was 1964. So I'm like the oldest Xer.
Well, so that was my argument because the whole idea of baby boomers were, World War II is over. The government was giving all sorts of incentives for the military folks to come back, get houses, get picket fences, get married, have kids. And so, how long after 1945 is when you say, okay, that phenomenon's over? I was born in 1963. And I'm arguing to my wife, no, 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 no. I'm not, the definition of boomer is wrong, and it's not
I,
holding any water.
I would agree. I think what I think is, Boomer should have been cut off at about 60 or 61. Then you have this group from 61 to about 73. That's kind of the different group. That's the real X. The people after a 75 are a lot different than the people born in 65. So I think we probably need a little sharper knife when we slice
Yeah,
and dice exactly what this generational thing
uh,
is.
I'm going to have you call my wife and explain this to her. So anyway, all right, so let's keep rolling here. Let's take a look at a couple other markets. We've got plenty of time here. Just really quickly, crude oil right now. It's just a bowl of spaghetti for me. I've got lines all over the place. We could ignore these lines, but it just seems like every time we get traction one way or the other, everything changes up.
Yeah, we are in a sell the rally. You can try and buy the dip situation here. And I would try to do this. I wouldn't try and day trade this stuff at all. What I'd be looking for is if we get down kind of into a value area, you can be a little bit long. If we get too expensive, you can try and be a little bit short. We still have, obviously, the election. That creates some issues a little bit. It's, the idea that one party is going to be drill, baby, drill, which is bearish actually for crude oil. We are the biggest crude oil producer in the world. Yes, the SPR is low, but the market is relatively well supplied. The other party is, we're going to have electric cars and all this. Under that party's watch, we became the world's largest crude oil producer. So again, we have kind of a tug of war here, and then we throw the Middle East on top of it. That can make for, again, keep size small during this time period simply because risks can change. And as you can see on your chart here, suddenly and rather violently. And right now, the Middle East is a little bit off the boil, and I'm sure everyone is trying to keep it off the boil, at least through the election. So that is, all the legitimate players, the illegitimate players may likely want to try and cause some trouble. So a bowl of spaghetti is right, and it's not really good spaghetti.
Yeah. All right. Let's go to gold though. Let's pick up some of these. Gold is like, there's all this, 3,000 gold by the end of the year. It's kind of, everyone's calling for it right now. Certainly a huge rally in gold in my lifetime. This is rare to see this kind of levels in gold. What do you think's
Rare, they're
going on here?
records.
Well, no, I know. I mean, literally, like I read the Council issued a report a couple of days ago, and they said, well, the first half of this calendar year resulted in record central bank purchases of gold, and mostly emerging markets. India, Poland, these kind of places. Russia, maybe Singapore. You could throw that in there. They're not really an emerging market. But that's a strong level of demand if you got a record central bank purchasing.
Right. You have very good, very stable diamond hands buying it. People who are not going to be getting rid of it. I have liked gold. I've been bullish on gold. Full disclosure, I own stocks in gold miners and mutual funds that own those miners. And I've liked gold. I'm liking it a little less and less, meaning, again, the idea of maybe reducing position a little bit is on the table. However, gold loves lower interest rates and a weaker dollar. Going back to what we just talked about, we are in a situation where over the near term interest rates could pull back, the dollar can come in, and that would again to keep the gold supported. But we are getting into an area where this rally is at some risk, and particularly a de-risking rally, where if we go risk off, you would think gold would go higher with risk off. What risk off means is I'm taking profitable positions that I have 500 on, I'm compressing that down to 200 or 100. And that's the sort of thing that could create a setback in here for the gold market. So again, we're kind of in that pins and needles situation.
Yeah. So I mean, I think yesterday everything to me seemed risk off. I mean, we had red all the way across the board except the 2 and 10-year yield. It was just in that little red, big red.
Yeah.
So, but then today it's like, all right, Tesla came out. Maybe it's not as bad. And we're kind of having a pause, maybe a little bit of green on the board.
Yeah, well, the week started with everyone being very nervous about the bond market, the interest rate situation, and everyone knows, hey, look, the 10 years going up. Well, that is about where, you start to see a market turn. That is where we have kind of changed position and, risk off again. Everyone can talk about the debt and deficit, all that. Over the near term, money will still flow into treasuries if there's a bad risk off sort of situation. So I think we may have extended. We've also moved rates up to a level where they may be a little bit more attractive for buyers.
Yeah, yeah. On that note, I was surprised. I think it was yesterday's. We had a 20-year bond auction. That's a weird kind of number, right? You're used to 30s, you're used to 10s, but there was a
Yeah.
20-year auction, a Treasury Department auction, and the bid cover ratio was pretty good. It was 2.65.
Mm-hmm.
62% was awarded at the high bid, so that's not that great, but it wasn't that bad either. I was shocked at that.
And that means people are obviously willing to buy it. And the 20-year again is kind of an odd bird out there, but people are willing to buy the odd bird because perhaps they're thinking that interest rates are going to have to come down. In this entire interest rate move, I thought we probably got a little bit ahead of ourselves based on the predication. This country is how many, $33 trillion in debt. When you move that interest rate up, you are adding to the budget woes. And I think the ideas about tamping down and keeping interest rates and bringing them back in, as long as we don't have an inflation problem, I think that is what is on the central banker's mind. And yes, Martha, they can do this. The enemy of inflation is technology. We get smarter. We do things more efficiently. 20 years ago, we couldn't have this TV show. This couldn't be going on. We
Yeah.
become that more efficient. And when you have efficiency, you can run budget deficits, you can run spending, and generally avoid inflation. And just look back at what happened other than with the pandemic. The inflation around the pandemic is a little bit different. Inflation can be hard to do. It takes structural disruption. We had structural disruption. We had the pandemic and all the spending and that money getting pushed into the economy. Well, money for nothing will cause inflation. Money for value doesn't. But when you have money for nothing, that will push inflation up. You also had supply chain problems. So with that naturally creates inflation. If you only have, 100 cases of beer to sell and you have people wanting to buy 300 cases of beer, the price of beer at the liquor store is going to go up. That's the other thing. And in some ways, it did mimic what happened in the 1970s. We came off the gold standard. We switched. We started to have these two income households. And going back to what we were talking about with the demographics, my mom stayed home all the time. The kids 3 years, 5 years younger than me, they weren't. Their growing up was different. And that's why I think,
Yeah.
Our generation for Jim and I is a little bit different than the traditional X ideas.
Yeah.
But you had that structural change, and then you had the oil shock, and that produced the inflation. And the pandemic, I think, in some ways, was a miniature version of that. But we're going to see the technology eventually offset that, and inflation will once again be harder to induce or harder to create in the economy. And, everyone loves to blame whoever is in the White House for inflation. I can assure you that if the President of the United States controlled inflation, they would have it constantly dialed back. There's a lot of things politicians can say that does not necessarily strike with what they can exactly do about things.
Yeah, no, I hear you. I hear you. I mean, right. And, and to some, some people would argue, well, it's actually good to have, and I'm going to go back to Robert Caro wrote a great book called Master of the Senate. It's one of 3 or 4 in a series about Lyndon B. Johnson, but the Master of the Senate book, a couple hundred pages on why the Senate is genius, and that's the way they set it up. It's because of the 6-year terms, 2-year staggered, 2-year staggered, 2-year staggered, and Robert Caro goes on to say this is a beautiful armor against mob mentality. And so my point is, you get one party controlling the Senate, another party controlling the White House. That actually ain't a bad equation.
No, that creates. What we need is obviously balanced government, and what we need to move away from is the red people. You think you're playing a game of Stratego or something, must get rid of the blue people. The blue people, we must get rid of the red people, instead of concentrating on good government.
Right. Yeah, exactly right. So, Sterling, we're up against time, and we didn't even get to the commodity charts yet.
We didn't get to the grains at all. We didn't get to the and I'll do this real quick. Caution and warning here. We've had a recent bounce in the grain markets. We're coming up against resistance area and Fibonacci numbers. November soybeans have given up all their gains. The January beans are reaching that contract. We've seen a lot of spreading with November stronger than January. Don't get fooled by that. The November contracts are coming up for delivery. Funds are rolling those positions. So while we've had a nice bounce and we've seen good export sales, we're not in a bull market here yet, and it's raining in Brazil, so we could definitely see prices come back.
All right. Well, hopefully I can get you back here sooner than later, and we could really do a deep dive on some of the commodities.
Anytime, Jim. I am available all the time.
The following presentation is for educational purposes only. All the symbols, trading ideas, and market commentary are for educational and demonstrational purposes only and are not recommendations or trading advice. Live sample trading occurs in a simulated environment. Past performance may not be indicative of future results. All the information and content presented is provided by NinjaTrader LLC, and the opinions expressed by all third-party guests are their own and are not necessarily those of NinjaTrader LLC. Trading futures involves substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.